All right, well, welcome back. And now we want to start talking a little bit about the classification. Okay, and so we're going to start off with debt securities, and we're going to talk first about trading securities. And so if we have an investment in debt and we classify it as a trading security, this is the notion that we're going to try to hold these securities with the hope of making a short-term trading profit. So the key here now is that we're going to report at fair value on the balance sheet. So these securities are going to show up at fair value. Any unrealized gain or loss on trading securities is going to be reported on the income statement. And so these unrealized gains and losses show up on the income statement and get treated just like realized gains and losses. So with trading securities, the related debit or credit to the unrealized gain and loss is usually made right to the trading securities investment account. However, we may also set up a contra account for something like allowance for change in fair value of allowances, investments. So we can make it the journal entry directly to the asset account, or we can set up a valuation account or a contra account, allowance for change in fair value investments. Now, I'll demonstrate that in one of the problems. Now, to determine the unrealized gains and loss, right, we take the current fair market value minus the current net carrying value of the trading securities portfolio. And so that's going to be basically, if we use the allowance account, the asset plus or minus the allowance. If we don't use the valuation account, it's just going to be the asset account. We recognize interest when earned, right? So interest revenue for trading securities can be calculated using the straight line or the effective interest method. Remember, the effective interest method is preferred. Cash interest always equals stated rate times face value. The difference is amortization of discount or premium, which is an adjustment directly to the asset account, just like we've been doing in the previous examples. When these securities are sold, the realized gain or profit is simply the difference between the sale price and the prior period fair market value, adjusted for any change in amortization. And we'll do an example of that. Now, if these assets, debt security investments, if these assets are classified as available for sale, right, they don't fit either the trading securities classification or the held to maturity classification, they still would get reported at fair value on the balance sheet. However, the big difference is that any unrealized gain or loss is going to be reported in other comprehensive income below net income line. And so the reason the FASB wanted this outside of the income statement is that they did not believe that short-term changes in prices of available for sale investments should affect the bottom line, net income. Because this is not really what the manager's main job is. So you think about Starbucks, right? Their main job is selling coffee. And so we really don't want to have unrealized holding gains and losses from their available for sale securities changing the importance of that net income number. And that's why they wanted that outside of net income. Now, with available for sale securities, we are going to set up a valuation account, and we're going to call it allowance for change in the fair value investments. And that can either have a debit balance or a credit balance. If we have a bunch of unrealized holding gains, it would have a debit balance. If it have losses, it's going to be a credit balance. And that unrealized holding gain or loss is going to be the current fair market value minus the current net carrying value. We recognize interest when earned just in the same way that we've been doing it. And when these securities are sold, the realized gain or loss is the difference between the sale price and the current amortized cost. All right, now let's get to the last category for debt investments. And this is, right, held to maturity. And again, you have to have both the intent to hold the debt investments to maturity and the ability to hold them to maturity. And we report this category of debt at amortized cost. So right? Initial cost adjusted for amortization as we go through the life of the bond. We don't use fair value for this account, for this category. There's no recognition of unrealized holding gains or losses. Interest revenue for trading securities can be calculated using the straight line or effective interest method, but the effective interest method is preferred. And at the sale date, realized gain or loss is simply the difference between the sale price and the amortized cost. For marketable equity securities, right, we're still in that category of no significant influence. And remember, that's less than 20 or 25%. And when we start thinking about significant influence, we'll spend a little bit more time on this when we get to the equity method. But what we mean by that is that the company is not going to be able to influence the investee. They have no board seats. They are not able to determine who the company is going to sell to. They are not going to be able to influence any investment decisions that the company might have. It's not going to participate in the policy-making process. There's no material intercompany transactions, and there's no technological dependency. So that's what we mean by no significant influence. For this situation, we're going to have both trading securities and available for sale. And, you know, they're equity securities, so they follow the same basic kind of four-step process that we have for the debt, but just a little bit of a difference. So they get reported on the balance sheet at fair value. We have unrealized holding gains and losses, and again, they're going to be calculated in the same manner. We take the current fair market value minus the current net carrying value. And we may have a valuation account for the trading securities. We may not. You know, what we're going to do in the homework is we're not going to have a valuation account. We recognize dividends when earned, and when a security is sold, the realized gain or loss is simply the difference between the sale price of the equity securities and the equity securities prior period fair market value. For available for sale securities, again, you know, we're going to report these at fair value on the balance sheet. Any unrealized holding gain or loss is reported in other comprehensive income, just like it is for the debt securities. And the related debit or credit is made to the valuation account, allowance for change in fair value of investments. So we do use a valuation account for this situation. We recognize dividends when earned, and when a security is sold, the realized gain or loss is simply the difference between the sale price and the equity security's original cost. Now, this is important because in this situation, it's different than it was for trading securities. And that's because for available for sale securities, the unrealized holding gains and losses haven't gone through the income statement. They've gone to other comprehensive income. And so it's going to be a little bit of an adjustment. We have to be really careful with these types of securities. Now, the balance in the investment accounts also changes when an investment is sold. So whenever you sell it, then you're going to take it out of that T account. A new investment is purchased. And then, this is an important one, right? Impairment. There's a permanent decline in the value of the securities. So if those investment assets are impaired, we will recognize a realized loss. And for debt securities, impairment occurs when it is probable that the investors will be unable to collect all amounts due according to the contractual terms. For equity securities, impairment occurs when the realizable value is lower than the carrying amount of the investments. All right. So before I get into the equity method, I'm going to stop here. I'm going to do some exercises, make sure that we understand all this, and then we'll come back and finish up the last couple subjects for Chapter 13 investments.